Hello, everybody. So today's meetup, we're going to be talking about dividends. So what are dividends? A portion of the company's earnings that is distributed to shareholders. So when a company makes a profit, they can either reinvest the money back into the company to grow the company, so to pay for research and development, like Tesla and Amazon. Those are two very big companies that don't pay dividends because they're constantly reinvesting the money that they make into the company to grow the different sectors, the different innovations, that kind of stuff, and creating new things, right? But if the company does not have suitable projects to generate better returns in the future, the board of directors may decide to pay the profits out to shareholders, and that is called a dividend. You own a dividend paying stock, every quarter you receive an amount of money based on the number of shares you have. So let's look at this example right here. Say you buy 100 shares of company A for $10 each. You've invested a total of 1,000. The dividend payout is 30 cents a year. So over the course of a year, you would receive $30 in dividend payments. So 100 shares times 30 cents, that's $30, right? Not all companies pay dividends, but those who do usually have a history of stability and growth. So take a look at these companies. Do you guys recognize any of these companies? Let me hear some names. What do you guys recognize? We have the Home Depot,
McDonald's,
the
McDonald's.
Scotch-Tape 3M.
Now, what is the similarity between all these companies?
You can find them like almost in every state in every country.
Yep.
Public.
They are basically recession proof. It doesn't matter if people have money or if they don't have money. You know, if they're worried about losing their job, they're going to buy Coca-Cola. They're going to go to Costco. You know, they're going to buy Clorox cleaning products, right? They're going to buy Apple. They're going to spend money on AT&T, right? For this one, AT&T right here, right? Home Depot, right? So they are kind of very stable. They are companies that have grown to basically all they can grow. Coca-Cola isn't going to be expanding anymore, right? So that's why they have no better thing to put the money into, no project with a greater return. So they decide to return that money to investors because they have no other better prospects, right? And companies like to keep their dividends stable and increase them over time. So this is UPS. This is the company I work for. And as you can see, the dividends have increased in a dollar amount per share amounts, dollar value, almost every year has increased somewhat, right? And that companies like to do that. So a company with a long history of dividend payments that decides to cut the payment, you might see the stock drop substantially because of that, because people are expecting the dividend to remain stable or to increase, right? But that doesn't necessarily mean a bad thing. You know, the company's management may have a plan to invest the money into a high return project that has the potential to magnify returns for shareholders over the long run, right? So companies in stable industry are the ones that tend to pay dividends, things that are recession proof, you know, healthcare, food, alcohol, utilities, materials, shaving cream like Procter and Gamble, Johnson and Johnson, those kind of things. Those are the ones that pay dividends, and the ones that are still growing can reinvest that money into the company, like Amazon, like Tesla, up until recently, Facebook, Google. All those companies are reinvesting it into other projects, right? So the advantages of dividend investing is you get a stable income. Like I said, the companies like to maintain their dividends stable. It's a consistent stream of income. So like a retiree might be a person who collects those dividend payments and kind of lives off them. And as long as they don't sell the stocks themselves, they have a money producing engine just churning out dividends every quarter. Now, these dividends tend to get paid once a quarter, but each company pays on different month. So that's why if you buy different companies, if you diversify a little bit, you'll get payments every single month, like you see in that picture. And dividends are also a good way to have generational wealth. Like you pay for yourself, and then you can pass the stocks on to your kids and have them live off the dividends and that kind of thing. And another cool thing about dividends is that they're often taxed at a lower rate than your ordinary income. So companies have to be stable to be able to pay these profits, and they try to keep them consistent, raise them every year. But one thing that I like to talk to people about is a dividend reinvestment plan, which is where you automatically reinvest dividends to purchase additional shares of stock, which is a strategy for compounding interest. So when you receive your dividends, you can choose to spend the money like a retiree might, or if you're young and still working and still building your portfolio, you can use that money, that dividend money, to buy more shares of the company, which increases the dividend payout the following quarter, which allows you to buy more shares for bigger dividend payout, and so on, which is compounding, right? So it's a great dividend. Stocks are great for generational wealth. They're a great strategy for compounding returns over time. And the difference can be huge. Take a look at, ignore the green line in the middle, which is where the dividends were invested in a savings account. So just ignore that. But look at the blue line at the top and the red line at the bottom. So if someone invested $10,000 in the S&P 500 over the last 40 years, so since, what is that? That's a little old, but let's just say 1980, right? 1980 to 2020. If somebody invested $10,000 40 years ago, and they spent all the dividends, today that $10,000 would be worth $86,000, right? You see here that little red thing, share price alone, no dividends, $86,000. But if they had taken those dividends and purchased additional shares of the S&P 500 index fund, today that money would be worth $238,000. And this is a little old. This is like 2020. So it's actually worth a lot more now in 2024. So when people talk about stocks in the stock market, they almost always talk about the share price, like the market is up, Tesla is at this many dollars, buy the dip. And those are all focused on the price of the stock or the price of the index that tracks the stock market. But these dividends really generate wealth. And as long as you reinvest it, it can be huge, you know. So the optimal path to wealth is boring. You know, buy and hold index funds, reinvest those dividends, never sell, and make it simple, you know. So I just saw this on Friday or Thursday. Facebook just announced a dividend. So they hadn't been paying dividends since they started, but they just announced dividends, a $2 a dividend, or a $2 dividend per share. Now, Mark Zuckerberg owns 350 million shares, so he stands to collect $700 million this year from just dividends. And he also stands to pay a 37% tax rate on that $700. Now, if that was regular income, he would have to pay something like 55%, which leads me into the next topic, taxes. Now, when you work, like America loves its investors. And so it gives investment income a lower tax rate than earned income when, you know, your job, the money you make through your job. So when you have ordinary dividends as opposed to qualified dividends, and I'll go into the difference in just a moment. But when you have ordinary dividends, they're taxed at ordinary income rate, and the maximum federal that you can pay on ordinary income is 37%. But then you have qualified dividends, and what is a qualified dividend? Well, there's two main characteristics that define a qualified dividend. It's as long as it's a U.S. company, so we're talking about the S&P 500, or we're talking about a total market index fund. Those are all U.S. stocks, like VTI, right? And as long as you hold the stock for more than 60 days. But I'm always telling you guys, you know, we do not buy and sell, you know, we buy and hold, right? So this was irrelevant for a buy and hold investor, holding the stock for more than 60 days, because you will be holding the stock for more than 60 days if you're buying and holding, right? So practically all of your investments, all of your dividends will be qualified dividends. So the maximum capital gains rate you can pay on qualified dividends is 20%. And of course, state taxes are also added to that after the fact. But it really goes to show that you can make quite a bit of money with investment income, like dividends, for example, and pay very little in taxes. Now, Mark Zuckerberg might be paying, you know, $256 million on that $700 million dividend payment, but most of you that are watching this probably don't make that much money. So you may actually not pay anything. So for a married couple making less than, I think it's something like $110,000 a year from all sources. So like say you make $80,000 from your job, and then you make another $30,000 from dividends. The $80,000 will be taxed at whatever it's taxed. But The 30,000 in dividends gets taxed at the long-term capital gains tax rate, which is maximum of 20%. But if you make less than I think it's 110,000 or something along those lines, if you make less than that amount, you pay 0 in federal taxes on qualified dividends. So this really is a good option to make money if you have the thing. But dividends are generally taxed. So even if you don't make that much now, my recommendation is to have any stock that pays dividends or pays interest or something along those lines. You want to avoid the taxes whenever possible. So you should put your dividend paying stocks within retirement accounts. So your 401k, your IRA, your Roth IRA, those are sheltered from taxes. So you don't have to pay taxes on your dividends for anything that's in there. Of course, if you make below that 110 or whatever, then you won't pay taxes anyway, but things can change, right? So there is this calculator online. It's at this website called Don't Quit Your Day Job, DQYDJ.com, don'tquityourdayjob.com. And there is a calculator where you can check how much an investment, from between 2 time periods would have performed. And in this case, my recommendation is always like an index fund, an S&P 500 index fund or a total market index fund. Basically, if you buy these things, you're getting a piece of profit every time any kind of economic activity happens in the US, because that's all US companies, right? If you have VTI, the total market index. So let's pretend, so I put these numbers into the calculator. We're looking at the S&P 500. We're looking at dividends being reinvested. And we're looking at somebody starting with nothing, but investing $500 a month. How would that have performed, right? I plugged in January 2014 to 2024, 10 years. So if you had invested $500 a month, starting with nothing, $500 a month, 10 years ago, you would have spent, the total invested would have been about $60,000. You would have had an annualized return of 12%. And the final value of your portfolio would be $112,000, right? And if you compare that to just the stock price, like you hadn't reinvested your dividends, you're about $5,000 less, which isn't that much, but that's only 10 years. The difference really starts to make sense when you look over a longer time period, right? So, but let's go 20 years back. Let's say you had invested $500 a month for the last 20 years, from 2004 to 2024. Your annualized return would be 10.9%. You would have invested a total of 120,000, because 500 a month, that's 6,000 a year times 20 years, 120,000. Your portfolio would be worth 400,000. And if you hadn't invested the extra dividends, you would have about 60,000 less. So now it starts to make a difference. Now you can kind of see the difference, right? Well, let's go back 30 years, 1994, right? Same thing, $500 a month. You would have had an annualized return. So the average annual return would have been about 9%. And the final value of your portfolio would be about 900,000 compared to about $700,000 without reinvesting those dividends. And let's go back to when the year I was born, 1984. I'm going to turn 40 this year, right? Let's pretend my parents had the foresight to put $500 into an S&P 500 index fund when I was born, and just did that every month. It would be about a 10% return is the actual return with the dividends reinvested in the last 40 years. And the final value of the portfolio would be about $2.7 million. Without the reinvested dividends, about 1.6 million. So you're missing out on over $1 million by not reinvesting those dividends, right? And let's pretend, this is kind of silly because so let's look at 60 years ago, right? And this is kind of a silly thought experiment because most of us are way too young to have invested 60 years ago. And everyone else who is older than that would probably have just been a kid and would not have known how to invest anywhere or had the capital to invest. And I know $500 60 years ago was worth a lot more than it was now, but just bear with me for the purpose of this illustration, right? So if you had invested 60 years ago, $500 a month, you would have received about a 10% return. So you know how I always mention 8%? Notice these things: 9.77%, 9.86%. That's 40 years. 30 years, 9.19%. The last 20 years, 10.9%. The last 10 years, 12%, right? these are returns. These are real life returns that you can probably expect. You know, the past doesn't necessarily predict the future, but you know, just because something happened like it did in the past doesn't necessarily mean it will continue into the future. But look at this. Look at this track record. 12%, 1%, 9%, 9%, 9%, right? So you can kind of expect with your reinvested dividends, you may very well get about a 10% return every year, right? And the final value of the portfolio here, after 60 years of just investing $500 a month, is $17 million. If you had invested 60 years, $500 a month, today it'd be worth that much. And if you think that's wild, imagine if you had $100,000 to start with. You know how I always say, get the money in the market, invest it as early as you possibly can? This is why, right? So let's pretend we had $100,000 to start with. We're, you know, the rules are the same. You know, we're doing an S&P 500 index fund. We're investing $500 in a month, and we're reinvesting those dividends, right? So if you had done that for the last 10 years, today your money would be worth $413,000. Start with 100,000, 500 a month, right? If you had done it in the last, 20 years ago, it would be worth almost $1 million. If you had done it 30 years ago, it'd be worth 2.4 million. 40 years ago, when I was born, 8.2 million. And then 60 years ago, it'd be worth 35 million. So you see, so the I don't know if you remember, but the one just the $500 a month was 17 million. So we have an additional $19 million that came just from that starting nest egg of $100,000. This is why it's so crucial to get your money invested as early in life as possible. And I don't mean to disappoint isn't the right word, but make you feel bad if if you don't consider yourself young. But the best time to plant a tree was 20 years ago. The second best time is when? It's now, right? So don't feel bad about not having invested 60 years ago, right? Start now if you haven't done so already, My advice in all this, any dividends you receive, as long as you're not retired, as long as you need the money, I would reinvest it for the long run, right? Buy and hold. What does that mean? That means you buy, you never sell until you retire. Buy and hold. Don't time the market. I have a client, I suppose we could call it a client because I get paid for our one-on-one sessions. She's always like, I keep trying to get her to invest the cash she has. And she's like, oh, no, the market's high. I don't want to put the money in. And then when the market drops, it's like, oh, the market's dropping. I'm going to wait till it bottoms out. And it never happens. And it's so frustrating. And so don't market time. When you have money, with every paycheck, set some money aside and invest it. And it doesn't necessarily have to be the S&P 500. It could be bonds, it could be real estate, it could be whatever it is that your asset allocation is, but consistently buy. Never sell, right? Until you need the money, right? And then my last piece of advice is if you have dividend producing stocks, put them in retirement accounts instead of, the tax sheltered retirement accounts instead of the taxable brokerage, right? And that is the end. Howdy, everybody.
Hello.
Hello.
Could you repeat the last two sentences there?
The last two sentences about investing or having your dividend producing stocks in retirement accounts?
Yeah.
Okay.
Explain that a little bit.
So you know how, so dividends are generally taxable, right? You may get taxed at a lower rate than your ordinary income, but they're still taxable. And so as a general rule, it's best to anything that produces annual payments that are taxable, you put them inside like a retirement account, a tax-free retirement account, like a 401k, an IRA, something like that, right? That will not get taxed. So for example, let's say I have $1 million of Facebook stock, right? Or I have the S&P 500 index fund, $1 million worth, right? And it pays a 2% dividend yield. So that's $20,000 a year. I'm going to get taxed on that 20,000 if I just receive, if I have like an E-Trade brokerage or just like a taxable brokerage, a Vanguard account. I'm sorry, a Robinhood account. You know, just your general taxable brokerage that allows you to buy and sell stocks and other, you know, other assets, right? I will get taxed on that 20,000. However, if I have that same investment, that same $1 million within a retirement account, that money is completely protected from taxes every year. You know, so if you have a traditional IRA or traditional 401k, when you retire, you'll have to pay taxes on the balance, right? Not with a Roth. If you have like a Roth IRA, Roth 401k, you got taxed when you put the money in. It's done. You'll never get taxed again on the growth on anything. But it's generally preferable to shield your interest and your dividend paying investments inside a retirement account, inside a tax protected retirement account, like your IRA or 401k or an HSA, a health savings account.
Okay.
So
Yeah,
is it, you know, like so many people were afraid of taxes, but if we pay them today, maybe in 5 years, my income is higher. So I'm going to pay more taxes. So then it's, you know, I don't know. When we think of that, shall I pay tax or not? And I don't know where I am with this. I don't think I have any dividends unless I just continue going back in there. There was one I had, and I know there were dividends, but I never knew how to keep track of them. And when I switched companies, I had no idea what happened.
The dividends generally get paid out as cash. So you would have seen in your settlement account within your brokerage, you would have seen a cash balance. Many companies do the DRIP, the dividend reinvestment plan, automatically. So they just automatically buy more shares, and that is preferable. You know, especially if you're growing your wealth, it's preferable to just reinvest those dividends into new shares, right? That's the preferable method. But sometimes you will need to collect that money, like if you're retired, but hopefully not, right? And so I do. So people who are in a high tax bracket, so we're thinking 24% and above, the general advice is to have traditional retirement accounts. So a traditional 401k, a traditional IRA. That's for people 24%. That's the general advice. Because you could take that extra money and invest it. And so it's better because we're assuming that you won't be in the 24 or the 37% tax bracket when you retire. But we're all aware of the $37 trillion debt the country has, right? It's going to have to get paid off, right? So in my mind, taxes are going to go up over time. And so that's why all of my contributions, I put it in a Roth, because for one thing, I'm only in the 12% tax bracket. I don't make that much money, right? And two, like even if I were in the 37% tax bracket, there's kind of a simplicity and a mental peace in just paying the taxes now, getting them out of the way, and the government will never tax me on that money again. It can, you know, if I pay taxes on like $100,000 that I contribute to my Roth IRA over the years, and then by the time I retire, it's worth $1 million, I'm not paying taxes on any of that money.